Welcome back to the Deep Dive. We are jumping right in today, looking at the government services sector.
Yep, specifically Booz Allen Hamilton, ticker BAH. We're covering their Q2 fiscal 26 results.
That's right, based on their earnings call from October 24th, pre-market.
And look, this was a complex one. Management came out pretty directly saying that this reacceleration everyone was hoping for, it's delayed.
Delayed is putting it mildly, maybe. They lowered expectations pretty much across the board for the fiscal year.
Definitely set a cautious tone. But, the story underneath those headlines is actually quite interesting. It's got layers.
So that's our mission today, right? To unpack why the outlook changed, what are the sort of internal gears grinding, and what external pressures are they facing?
Because the market reaction was pretty immediate, but maybe missed some of that nuance.
Okay, let's start there then. The reaction, it was driven by the misses on the key numbers, wasn't it?
Absolutely. The headline figures confirmed some fears about the federal budget cycle, I think.
So adjusted EPS, ADPS, that landed at $1.49.
Yeah, $1.49, just missing the $1.53 consensus.
Yeah.
But the bigger one really was revenue.
Right, $2.890 billion. The street was looking for closer to $3 billion.
Exactly. And that translates to an 8.1% drop year over year. That's a significant reversal. You could almost feel the pressure in the numbers.
And that pressure hit margins, too.
For sure. Adjusted EBITDA margin came in at 11.2%. Now, that's down 40 basis points from last year.
Okay, 40 basis points isn't like a huge percentage in absolute terms, but for a services company?
It signals real strain, exactly. Margins are already pretty tight.
Yeah.
And the market, reacted instantly.
So it dropped sharply, right? Like 9%.
Yeah, in early trading. And the volume was huge, maybe 4 or 5 times the average. The market clearly saw the guidance cut and, didn't look much further initially.
Okay, so let's get into the why. Management kept using this word, bifurcated.
Bifurcated, yes.
Yeah,
That's probably the single most critical concept from the call. It means the company is essentially living in 2 different realities at the same time.
2 realities, how so?
You've got the civil portfolio, think agencies like HHS, Homeland Security, and then you've got the national security portfolio. And they're heading in opposite directions.
Okay, so let's take civil first. They described that market pretty starkly, didn't they?
They called it the most challenging market in a generation. I mean, that's incredibly strong language for an earnings call.
Wow. So what's causing such a challenge? What's the friction?
It really boils down to procurement speed and funding pace. Q2 usually lines up with the government's fiscal year end.
Right. When you expect a flurry of activity, those plus-ups as agencies spend remaining funds.
Exactly. But BAH said they basically saw none of that this time. It was just slow, delayed, uncertain funding increments.
And that procurement logjam just kind of pushed everything back.
Pushed back the expected return to growth for civil by several quarters, yeah.
And the financial hit, I saw the forecast.
It's staggering. Full year fiscal 26 revenue for the civil business is now expected to decline in the low 20% range.
Low 20s. That is a massive, massive hole.
It really is.
Yeah.
But then, you flip the coin. You look at national security.
Defense, intel, cyber, AI. That side
is robust. Still seeing strong demand, still projected to grow top-line revenue in the mid-single digits for the full year.
So even with some friction there, too, they mentioned slower ramp-ups.
Yeah, there's still some friction, like shorter funding periods, slower starts on contracts, but the fundamental demand for mission-critical stuff, it's high, very high.
And the wins they announced seem to back that up, the bookings.
Oh, the bookings were incredible. $7.2 billion in gross bookings for the quarter. And get this, 90% of that was in national security.
Okay, $7.2 billion. That's a huge number. Any standout wins?
Absolutely. The big one was the nearly $1.2 billion Shadow Raptor task order. That's Air Force Research Lab stuff, cutting edge.
Not just standard IT support, then.
No. This is future warfighting tech. They also bagged 3 other awards over $800 million each. One was even a competitive takeaway win with the Army National Guard.
So in the areas where the government has to spend AI, cyber, defense modernization, BAH is clearly winning.
They are. Beltec even confirmed they're the largest AI provider to the federal government. So the strategy in Nat-Sec seems to be working.
Which brings us back to the paradox. Record bookings, Nat-Sec growing. Why the overall guide down? Why couldn't $7.2 billion in new contracts prevent that?
It's really just the math, unfortunately. A low 20% drop in a big segment like civil.
Yeah.
Well, mid-single-digit growth elsewhere just can't fully absorb that kind of shock.
So Nat-Sec softened the blow but couldn't prevent the overall decline.
Exactly, which forced the company-wide guidance reset.
Okay, let's just quickly recap that reset. Revised revenue now $11.3 to $11.5 billion.
Yep, which is a year-over-year decline of 4% to 6%.
And ADPS, the earnings per share, revised down to $5.45 to $5.65.
That's the tough near-term picture. But, and this is important, management isn't just sitting back, they're making some pretty aggressive moves.
This is where the strategic pivot comes in, right? The cost cuts and the investment shifts.
Exactly. This is where it gets really interesting from a longer-term perspective.
Okay, let's talk cost reduction first. That number seemed pretty big.
It is. They're targeting $150 million in annualized savings. That's significant.
How are they planning to get there? Just headcount?
It's partly simplifying the operating model, but they specifically mentioned leveraging AI internally to streamline their own processes. That's key.
Using their own medicine, so to speak. And the full impact hits when?
Not fully until FY27. So they're essentially building margin firepower for next year right now.
Okay, creating future capacity. And where are they focusing their investments?
Very specific areas. Cyber, especially their ThunderDum Zero Trust product. Advanced AI, they mentioned agentic and adversarial AI. And warfighting tech.
Like those specific product names they dropped. MDK and TAC SIDX?
Exactly. Modular detachment kit, TAC SEDX. These sound like next-gen ground systems, fire control solutions. It's about intellectual property, IP.
Which ties into that other big shift they talked about, outcome-based contracting.
Absolutely. This is fundamental. Moving away from just selling hours, the traditional cost-plus model.
Where the government pays for time and materials plus a fee.
Right. Outcome-based means selling a solution, a product, their IP. They get paid for delivering a specific result or capability.
So productizing things like MDK and TAC SIDX.
Precisely. And the potential upside is much higher margins because they're rewarded for efficiency and the value of their IP, not just the number of bodies on the contract.
That makes sense. And connecting that back, they also mentioned staffing changes, didn't they? Particularly in civil.
Yeah, that was a critical point. Civil-facing staff down 10% year over year. That's a significant workforce adjustment happening alongside this push for automation and outcome-based work.
So cutting costs, redirecting resources, and trying to fundamentally change how they make money. That's a lot happening at once.
It's a major transformation effort happening under pressure.
Okay, let's revisit that booking paradox again. The $7.2 billion number, the $40 billion backlog. If you're an investor, why isn't that enough?
That's the core friction point, isn't it? The book-to-bill ratio is fantastic 1.7 times for the quarter. Even higher, over 2.0 times, if you adjust for some contract ceiling stuff.
And total backlog hit a record $40 billion, up 3% year over year.
So the demand is absolutely there. The future work is, technically secured.
But it's not turning into cash fast enough.
That's the bottleneck. The slow procurement environment means that huge backlog isn't converting quickly into funded task orders, into work they can actually start delivering and billing for. The contracts are there, but the starting gun is delayed by funding issues.
And that delay, combined with the shift away from civil, is what's hurting margins now.
Yes, exactly. The mix shift is unfavorable in the short term.
Why does civil have such an outsized impact on margins?
Historically, that civil business had a higher proportion of fixed-price contracts. Those tend to carry better margins, maybe closer to 13% sometimes.
Compared to national security.
Which relies more heavily on traditional cost-plus work, typically running in the, say, 8% to 10% margin range. So when your high-margin work declines sharply, the overall company average gets dragged down.
Got it. And on top of all that internal stuff, they had the external factor of a potential government shutdown looming.
Right, they quantify that too.
Yeah.
Said a shutdown through October 31st would cost about $30 million in revenue and $15 million in profit. Just another layer of instability they have to manage.
Okay. So for someone listening, trying to make sense of this, the core tension is what? Long-term promise versus short-term pain.
I think that sums it up well. BAH has this really compelling story about dominating future-proof areas like AI and cyber, and they have a massive $40 billion backlog to prove the demand.
But the current federal funding mess and the deep cut in civil mean the payoff is delayed by, several quarters?
Exactly. Performance expectations have been reset.
So if things are delayed, what catalysts should people watch for? What could make the stock perhaps re-rate faster than this new lower guidance implies?
Well, number one is any sign of that federal procurement logjam breaking, especially in civil. Faster funding flows would unlock that backlog.
Okay. Normalization of procurement. What else?
Second, watch the conversion rate itself. If that $40 billion backlog starts turning into actual revenue faster than management currently expects, that would be a major positive surprise.
And third?
Progress on those cost savings. Hitting or exceeding that $150 million annualized target shows they're building that future margin power. That could get priced in earlier.
It's interesting, too, that despite all these headwinds, the company seems pretty confident financially. Balance sheet looks okay?
Very much so. They ended the quarter with over $800 million in cash, 816 AM, and net leverage at just 2.5 times. That's quite manageable.
And their actions spoke volumes, too, right? Capital allocation.
Absolutely. They put $279 million to work in Q2, dividends, buybacks. They increased the dividend. And importantly, they boosted the share repurchase authorization by another $500 million.
Bringing the total buyback capacity to almost $900 million, 880 M.
Yeah. That's management basically saying, we think our stock is cheap right now, and we believe in the long-term plan. It signals significant confidence despite the near-term pain.
Which is a perfect segue into our final segment. Time to put on our hypothetical analyst hats. Remember, this is not financial advice.
Right, just an outrageous but plausible trade idea for discussion. The premise here is that the market has overreacted.
Overreacted specifically to the civil decline and the guidance cut, priced in the worst-case friction.
Yeah, essentially assuming things stay bad for a long time. But the opportunity might be that BAH isn't just another government services firm anymore. They're changing.
Okay, so what's the trade idea?
The idea. Go long BAH, but finance it by shorting a sort of generic, lower-tech government services competitor. That on the differentiation.
Long BAH, short generic Gov Services, Inc. What's the core rationale?
It's basically a bet on two things happening. One, that huge $40 billion backlog eventually does convert. Two, that $150 million cost reduction program significantly moves margins starting in FY27.
Creating a spring load effect for performance down the road.
Exactly. And those strategic bets they're making, AI, cyber, outcome-based contracts, those are designed to fundamentally change BAH's margin profile and maybe even its valuation multiple over the next couple of years.
While the generic competitor,
the pure cost plus labor shops, they might face existential margin pressure if this funding friction doesn't ease up. They don't have the same strategic levers to pull.
So it's a bet on BAH's transformation and cost discipline winning out over sector stagnation, while the market's still fixated on today's budget headaches.
That's the thesis. So to wrap it up, yes, the civil market challenge is real and severe right now.
But it's countered by that resilient national security demand and those record bookings.
And management's response, the cost cuts, the investment pivot, the push to outcome-based tech, it's aggressive and transformative.
Which leads us to that final provocative thought. They mentioned the 10% cut in civil staff and this push towards outcome-based work and said future growth is becoming less linearly connected to headcount.
Right. Is this the beginning of something bigger? A decoupling of revenue from just adding more bodies?
Could BAH start looking less like a traditional consultancy and, I don't know, more like a high-growth tech enabler in the federal space over the medium term?
It definitely makes you wonder if the valuation framework needs to evolve, doesn't it? Food for thought.
Indeed. Okay, that's our deep dive for today. Thanks for joining us.
And please remember, everything we discussed is just information synthesis and our perspective. It is absolutely not financial advice.
Always consult your own financial advisors before making any investment decisions, and maybe dig into those contract conversion dynamics yourself. We'll catch you on the next deep dive.